2026 is coming to a close, so we found no better time than to review all of the different executive orders, propaganda, what's true, what's not, for housing. Mortgage rates, we have different programs that are being talked about. Trump versus Jerome Powell.
I'll be honest, I'd love to fire his ass. Guy's grossly incompetent.
Where are we at in the debacle with the White House versus the Federal Reserve? And Trump's promises pre-campaign that surrounded housing. We've been tracking them now for over 10 months. Let's see which have come to fruition and see whether or not housing in 2026 be any better with some predictions.
Your profit on a mere $6,000 investment would be upwards of $60,000.
So let's go to the board real quick to get started with some fast facts. Facts about the housing market. Pricing nationally. This is the median price, and I got this from the Fed Reserve website. So if you want to look this up, it's the median home price on the Fed Reserve of St. Louis website. This is median pricing at the beginning of the year. Pricing was at $414,500. Pricing on median is down. It is down almost $4,000. So the median price of a home in America right now is $410,800, again down from January at $414,500. Supply of housing. The amount of homes currently on the market, we are not in a supply crisis anymore. We have over 1 million homes on the market, though we typically would want to see 1.6, 1.8, even over 2 million. The real crisis is in affordable supply. Supply, though, is up. At the beginning of the year, we had 829,376 homes on the market. Today, we have 1.1 million and one home on the market. That might change. That's probably changed since I've gotten the number. That one home is probably on or off the market at this point. But supply is going up and pricing is being compressed down. This is a good sign. This is a proper sign for the future if you want prices to be compressed downward. Why? Let's go back to the board real quick. I love to use the analogy of the banana. If somebody were selling a banana and their job was to find people who wanted to buy said banana, we can do the whole supply demand thing right here. Because when we have buyers of the banana, we have demand. And we have sellers of the banana, that means we have supply. If you're the seller and you have the buyer over here, what would happen if you had 10 bananas and 10 banana buyers? Well, you're going to have a neutral pricing scenario there because you have an ample amount of demand to feed your supply. You could even probably increase pricing so you can hold over a little bit of supply, but we won't get into logistics. Now, what happens if you have 1 banana and 10 banana buyers? Well, let me bring you back to COVID. Remember when everyone got told to leave for 2 weeks, go sit in your home, play some video games for a little bit? Let us think about this whole flesh-eating virus, see what's going on. What happened was we had a lot of people that still wanted to buy bananas, still wanted to buy homes, but not a lot of people wanted that flesh-eating virus going through their home without a mask. So what happened was we saw pricing go up. As the supply of homes went down and demand stayed high, we saw pricing go up. Now, what happens when the opposite happens? If we have 1 banana buyer and 10 bananas, well, the opposite scenario happens because now this banana buyer, he can shop around. He can check out all the different bananas, the different banana suppliers, see what's going on in the banana market. And that leads you as the banana seller to think, are you either going to sell less bananas or sell them at a lower price to get this done? All right. So let's move back into our main screen. I want to bring up our Canva graphic. So as of right now, we have a lot going on. Trump has made a lot of promises around housing. Trump has made a lot of comments around housing. Scott Turner, the head of the Housing and Urban Development Division, and Pulte, who's within the cabinet around housing, and also the CEO of Pulte Homes, one of the largest builders in America. This is our current administration set up around housing, and they have made some moves. I want to start with the moves made around mortgages. Then we're going to walk into what Trump has specifically done with Powell, affordability, and his initial campaign promises of Agenda 47. And then at the very end, I have some predictions that we'll walk through. 3 hidden by the great Shreks. The great Shreks guard our eyes from the predictions. And one other thing over there. We'll see what's behind that one. So 4 legendary Shreks have entered the scene. We'll see what's behind them. But we're going to start in mortgage mania. So we're going to run through this real fast so we can be on the same page of what's real and what's not. And we'll start from the top. FHA loan changes. There have been 2. The first one I put over on the left. We don't have to click into this article, but if you're watching on Spotify and on YouTube, the link to this document will be in the description. This will be in the description. Now, the FHA loan changes specifically that we had was there are going to be no credit limits on the minimum for a bank. There's going to be no minimum credit required for a government-backed loan. This affects FHA, VA, USDA. FHA insured loans are no longer going to require a credit score. This was from Freddie and Fannie Mac. And what this means is that banks will now have the ability to use credit score as a guideline, but 620 will no longer be the hard minimum. You're still going to have proper income. You're still going to have a job. You're still going to have tax returns and savings. But they are going to focus less on the credit score. Number two, and this is actually the article that I have linked to it for FHA loan changes, is that also back in May, we took away the ability for people that are not permanent U.S. residents to get a government loan. I would say this is another win on the side of the administration as far as it goes for housing, because we did have a small percentage of, it was about 80 to 70,000 a year, undocumented immigrants purchasing properties. And they would do through not their social security number, but their taxpayer ID number, which they would still have access to. And some bankers, some mortgage providers would allow for these types of mortgages to get put out. But ever since May, we've seen a steep drop off, as now that is not something they can do. So we are seeing less demand come from people who aren't actually citizens of America buying homes. And that's the FHA loan updates. Let's get to our next mortgage update. The next one that we see is the 50-year mortgage. This isn't a win. I also don't think it's going to happen. The 50-year mortgage was talked about and then echoed by Pulte on Truth and X. Now, the 50-year mortgage is being called a affordability hack, a lending tool, another tool in the tool belt. But quite honestly, it's renting from the bank. It's renting from the bank. If you spend 10 years in a home under a 30-year mortgage, you're going to have on a $400K home about $40,000 to $50,000 in equity at the 10-year mark. And I did do a video, which if you're in this document, which there will be a link to in the Spotify, YouTube versions, you can click, watch. It's about 6 minutes. There was a lender who I highly respect who said they're great. I do not think they're great. Because even at the end of that 10-year period, on a 50-year loan, where you would normally have about $50,000 in equity, you now only have $14,000 in equity, meaning you can't sell it, meaning you more likely can't even refi it. And it's like renting, except you're paying the rent to the bank, and the bank's not going to fix your dishwasher when it breaks. At the very least, a landlord would do that. The 50-year mortgage also, I do not think actually happens. We would have to create a 50-year bond. I don't think we'd get buyers for that bond. The only people who'd want to buy that 50-year bond is us. We would need to buy our own supply. I don't think it happens. And if it does, I don't think it helps. Our next mortgage program that's being talked about is the portable mortgage. Now, we've done 2 videos now on this. I've linked one in this video. I don't know why it's doing the same screenshot. That is a different video. But we are seeing the possibility, and I will say a more likely possibility, for the portable mortgage. Now, what's the portable mortgage? I might have to draw this one out. Portable mortgage is a little confusing. On a portable mortgage, essentially, I'm only going to erase part of it. Psych, we're live. We do what we can. We'll erase all of it. On the portable mortgage, so let's say you have a home, and you bought this home back in 2021 at a, let's say not even a 4% interest rate. Let's say you got real crazy with it. You got 2.5% interest rate, paid that baby down a little bit. And you bought it at $300,000. Now, you need to move. Somebody has died, and now you got to go back to family, or your wife got a job somewhere, and you got to go. Now, typically, let's just go ahead and call it 2026 is when you close on any home if you were even to buy today. That $300K home, a similar type home, probably worth $500K now. And that's depending on the market you're moving into. And the huge difference is now you're getting a 6.5% rate. Could be a 6.2, maybe high 5 if government, but regardless, a lot higher than it was. The portable mortgage will allow you to take your interest rate from the last home and bring it to the new home. And a lot of people who are sitting on equity because they bought it at a lower price and they got like $200K in equity they want access to. And for people that are locked into housing that simply can't get out of this home, well, if they could bring their mortgage with them and bring this down to even a 3.5%, it makes it a lot more probable that it would work. Now, of course, this does not help the first-time home buyer at all. In fact, it kind of keeps them out of the game slightly because it unlocks demand from the person who already owns a property and has a low mortgage or refied during that time, but doesn't really do anything from those sitting on the outside looking in, except you'll see more lower cost homes that first-time buyers bought 4, 5, 6 years ago that will probably come back into the market. But again, when affordable housing hits the market, what have we said on this channel multiple times? Investors buy it. 1/3 of all homes purchased in 2025 so far, not even counting affordable homes, this is counting all homes, 33% of all homes purchased in America this year have been purchased by an investor. And that's not BlackRock, okay? It's not just private equity. They buy a very, very, very low percentage of homes. Blackstone owns over 300,000 units. BlackRock owns under 10,000 units. And they're not buying individual homes. They're not beating you to the closing table. The large segment of buyers on the investment sake is the mom and pop. It's the Uncle Fred. It's the coworker that wants their 7th Airbnb. It's the person that wants the 13th home in their rental portfolio. It's not BlackRock. And you can Google this. I hate BlackRock, by the way. We got a certified BlackRock hater shirt linked below. But BlackRock's not the one buying the homes. Blackstone, the other black mineral, is, which, by the way, same legs of the same entity. I get it. Arms of the same bird, whatever. I get it. But we got to be factually accurate. And when it comes down to portable mortgages, I do think this unlocks demand from the people that are locked in. But again, the first-time buyer, not a lot of benefit. Let's go to this last one. Another thing with the portable mortgage, too, that I'll bring up is the only thing that could prevent this from happening. Canada and the European Union already have portable mortgages. Porting a mortgage is very common, but they have a much different mortgage setup. Like, they don't sell their mortgages to another company the moment that they get purchased. If you were to purchase a home with your local credit union, they're probably going to sell the mortgage to a bigger company. And they have 25-year mortgages that re-up at a new rate every 5 years. So they're basically like almost long-term adjustable rate mortgages. We'd have to change our system up dramatically to make portable mortgages work. It's the last thing I'll say about that. Let's go to the last one. This is the no credit score. I mentioned this earlier. I wanted to walk through some documentation. This is from PennyMac. Again, you can click on this in the Canva. We won't, but this labels out all of the minimums and maximums they had previously. This entire document that I'm showing you right now is still accurate except for one item. And we can scroll over to the left to see that one item. If you go all the way down to page 8 in this document, you'll see that buyers may have no credit score. No credit score. You can extend that out? Let me read the whole sentence. Let's do that. I must have messed that up. Beautiful. Could we bring it out right too? Is there more room on the right? Oh my goodness. All right. All good. Sean for the win. It says all borrowers may have no credit score. Freddie Mac and LPA requirements must be met for a loan to value above 95%, blah, 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 blah. Pay off all existing judgments, tax liens, payment history. It walks through all the other items you need, but you can see there very clearly no credit score requirement. Now, this does not mean that 620 is no longer going to be a minimum at your bank, or that 620 isn't going to still remain a minimum for most banks. In fact, for a lot of mortgage programs, you need a 640, some even a 680 for first-time homebuyer programs. This does mean that some banks will lower that minimum. Some banks are already able to divvy out loans for FHA at 560 and 580, but this will expand the amount of demand. There'll be people who are held back by their credit score that make good income, have good savings, have a good job, and they'll be able to buy now. But this will be bank by bank. And if there's anything that I know from looking at the history of when we start to loosen regulations and people say, oh, well, everybody won't do it, it won't get that bad. Eventually, everyone starts doing it. So yet to be seen on that one. Let's go back to our Canva. That is Mortgage Mania. That's the update we have from the mortgage world. Now let's talk about housing and Trump. There's been a lot going on. You can see this is the most filled out section of our Canva. We have Powell. We have his pre-campaign promises of Agenda 47. But we're going to start on Trump on affordability. So we don't have any clips to play from this one. I should have linked a couple, but I'll link some in the Canva for later. If you're clicking on this, you'll see a few items that weren't here in our video. But from the very beginning, Trump set up a committee. And the committee was set up to fix the deterioration of the American housing market. Now, that link right there below, could we click to that link, where it says link here? This was the initial document. Oh, is there no link? Did I really put the button link here and didn't put the link? Big L. I'm the worst, dog. So this was an initial document put out by the White House by the Affordability Committee. So there was a committee put together for the affordability of Americans, the cost of living of Americans. And that document is linked in this document. You can see the initial executive order pushed out. If we scroll up just a little bit, keep going. It'll be that first one. Price relief for all Americans in defeating the cost of living crisis. If we go over to the left, I've highlighted the area of that document I think is the most important. It says we are going to lower the cost of living in gray, and then down in the yellow, it says within 30 days of the date of this memorandum, the assistant to the president for economic policy shall report to me every 30 days thereafter on the status of the implementation of this memorandum. That memorandum over to the right came out at the end of January. I want you to guess how many updates we've gotten every 30 days over the last 10 months since then. If your guess was 0, you'd be correct. We've had absolutely no updates from this committee outside of that document at the bottom that I showed you originally that they dropped to show how drastic the problem is. The document's fine. The document's spot on. It talks about affordability. It talks about the age gap. It talks about the wealth gap. Locks it in, but nothing's been done. And we don't have any recordings of any other meetings they've had. If we go to the right and up, we'll see that Donald Trump also has vowed to increase home ownership despite affordability being at an all-time low. He said, together we can put millions more American families in a home of their own. And if we scroll up, we'll see, I think we might be able to click that one. Yeah, let's click that one. So this was Donald Trump after a cabinet meeting. It was in late October. It was like late August, where he was asked around housing, and he stated, we might declare a national housing emergency. 2 questions around this. A, what does that mean? And B, is it going to happen? Let's go to the camera. A, what does it mean? Reading into the Scott Bessent remarks, we really don't know what it means. Trump has not laid out the specifics at all. But what Scott Bessent has said, and I think we have linked in the document as well that you could read, it says that all of the properties that are currently zoned throughout the country, the local zoning efforts are what's holding back a lot of the building. The local zoning efforts are what's holding back a lot of the building, and they want to do away with that. They want to get into a federal ordinated zoning process with this federal housing emergency, basically changing how localities operate in their city zoning laws, county zoning laws, and state zoning laws. They also want to reduce regulatory costs for builders. Again, will either of these things fix the first-time homebuyer process? Theoretically, possibly, but to be frank, to go federally into the localities and get into the local boards and change local zoning laws at a federal level is overstepping a lot of bounds. And I also don't think it could happen. I do not think it could happen. On the side of regulatory costs, I think it could happen, but we'll touch on that in Agenda 47 a little bit later. Let's get back into our graphic. Again, we're on affordability. And if we scroll up to the top of the affordability left section, we'll see that HUD Secretary Scott Turner and DOI Secretary Doug Burgum, there he is. Those guys. Scott Turner played for the Ravens, by the way. That's his qualifications to run HUD. Announced joint task force to use federal lands for affordable housing. This is called BLM land, Bureau of Land Management land. And we can see that they want to take this federal land and build housing on it. This was an announcement that was made in May. If we go over to the left, we'll see a letter that was sent in by Senator Ruben Gallego out of Arizona, voicing his interest in collaborating on the newly announced federal initiative different I word, and explore housing development for public lands. This letter says, hey, what's going on? You had this thing back in January, and now you have this thing here in April going into May, and we don't know what's going on. And if we go over to the right, we'll see that development of federally held lands in early stages and details are still unclear. While the concept of expanding housing development on the federal held lands is straightforward, practical challenges exist related to infrastructure and resource capabilities. Developing these areas will require a significant investment into public infrastructure and will increase demand on already strained water resources in many Western states. Utilizing BLM land is stupid. I don't know what other way to put it. You look at the logistics of it. You look at the specifics of how the BLM holds land and how they're allowed to sell it. But they want to do this to solve the housing affordability crisis. Okay, so this can work in areas like Vegas. Let me explain why. So Vegas is this little town right here. This is the town of Vegas. It looks like an ocean. This is the town of Vegas. If you have ever been to Vegas, if you've ever flown into Las Vegas, you will know that the greater portion in or around Vegas, this is scaled to proper size. It's probably even bigger. All of this is empty. It's just desert. You got mountains out here. It's actually kind of beautiful. Great hikes. BLM land is a lot of the land that's owned in or around what's known as Las Vegas. BLM land actually has already strategically been utilized in Vegas to expand the already existing infrastructure. Hear me. BLM has successfully been used to expand already existing infrastructure. They've been able to build out on an area that's already working and already growing. And by the way, we're already seeing a big drop in tourism, consumer spend, and things in Vegas. I don't know if those two things are connected, but the BLM land here works because you have infrastructure that is being built onto with this BLM land. Now, if we were to look at any area, like if we were to look at New Hampshire, or if we were to look at Vermont, if we were to look at anywhere in the Southeast, here's what it normally looks like. Infrastructure, 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 town, infrastructure, parking center, shopping center, protected lands for woods, park. You don't have room or the BLM land around that infrastructure to add on to it. This would only partially work in segmented areas of our country. Very segmented areas of our country that meet very specific protocol for it to be able to work. And also, BLM, Bureau of Land Management, cannot sell the land back to the state or county for less than market value. So if they're selling the land back to the county for less than market value and builders are getting no incentive to be able to build the home at any lesser cost, what makes us think this is going to create affordable housing? We've already mentioned we're not in a supply crisis. We're in an affordable supply crisis. So let's go back into our Canva. The second biggest item that has been going on with Trump. Do we want to do that video on inflation and affordability real fast? Or do we want to come back to it, Sean? What do you think? We can do it now? We're going to do it now. So this is Donald Trump talking about inflation. Let's go ahead and play this video. This is very recent from his White House cabinet meetings. Go ahead and click on that. That's good.
On day 38 of the government shutdown and after an election that saw Democrats dominate across the country, President Donald Trump is turning his focus to one of the central issues that fueled his 2024 campaign.
Inflation is way down. The biggest thing is inflation. The second biggest thing is energy. Energy is way down, and what's also down? Gasoline. Also, the biggest thing is inflation, and it's way down. The reason I don't want to talk about affordability is because everybody knows that it's far less expensive under Trump than it was under sleepy Joe Biden. And the prices are way down.
Nope.
Pretty angry there.
Nope. Yeah, a lot of those things are just categorically false. Inflation is at 3%, the highest rate it's been all year, and power costs are not down. Can we go to the housing affordability tracker? We created a tracker back in 2024, late 2024, to track all the promises that Donald Trump made around affordability. We're tracking housing. We're tracking supply. We're tracking mortgage rates. We're tracking the cost of the items that go into building a home. We're going to the cost of new construction housing. The cost of once you own the home, how much does it cost to live in it? Your bills. Let's look at these items real quick under cost trackers. We have softwood lumber, steel, shingles, plumbing, concrete, power, milk, eggs, bread. We can move my head real quick. Boneless chicken. If we, there we go, bouncing around. Gallon of gas, home insurance, car insurance, medical care, beef, coffee, car parts, childcare, education, clothing, used cars, health insurance, rent. Look at all the red. Okay, the only drops we've seen is in softwood lumber, and we haven't seen the tariffs hit that from crossing the Canada border quite yet. And eggs and bread. Eggs are down the most significant, and a lot of that has to do with the fact he was coming in at the end of the bird flu affecting the egg supply very drastically. That kind of got put through the wash and fixed in or around February. So that's why prices have dropped significantly. But if we look at everything else, and we have power on here somewhere, right? Where's power? You see power? Right here. Yeah, power per kilowatt. Rise 5%. And that's just the reported numbers. Many people are saying that their power bills since 2020 have gone up 40%, 60%, even doubled. So when we're talking about inflation is gone, no, it is not. When we talk about power is down, no, it is not. And we're looking even a gallon of gas. You will yell about gallon of gas being close to $2 nationally. We're at $3.23 nationally. We're 2 cents up from when we started. So we're not down. We're definitely not at records. And there's been no data to show that we're going to have power bills come down, oil heating come down, or any of these line items we have from car parts to coffee to HVAC systems are going to come down. Tariffs are affecting a lot, and affordability is very real. So we have to see through the noise, see through the propaganda, see through the media and the misleading of our market, and look at the straight numbers. The straight numbers say neither of those things is true. Now, let's go back into our Canva document. And also, too, for anybody that views numbers, data, graphs, things that we can take from multiple sources and corroborate across political lines and take in even things from like BBC across the water. When we look at all these numbers and you still feel, oh, this is bias, check yourself. That's all I'm going to say. Let's move on to the next section of our Canva graphic. We have Trump versus Powell. This has been the conversation around rates. The conversation around rates has been a stark debate across the summer. Donald Trump and Jerome Powell have been going back and forth. We can play that video real quick on a more recent take that he had on Mr. Powell.
I'll be honest, I'd love to fire his ass. He should be fired. Guy's grossly incompetent.
Guy's grossly incompetent. And that argument could be had left or right. I'm not here to make that debate. But Donald Trump says he's a knucklehead, stupid guy. He really is. You know, each point, think of this, each point could cost us billions of dollars. And he's not wrong. Okay, he's not wrong. Every percentage point higher on our bond market, not necessarily Fed rate, the bond market is a higher amount of debt that we have to pay on, a higher interest rate that we have to pay on our new debt that is re-upping. And there's a lot of long-term debt that is re-upping, and our government is having to pay on that debt. And if our rates in our bond market are higher, the cost of paying down that debt becomes harder. And it goes up. In our last video, we went through the debt tracker, and we saw that the United States military spend is now below the debt spend. The interest on the debt is now higher than what we pay on our entire industrial military system. That is wild. That is wild. So he's right there, but Trump wants us to slash down to 1% rates. That is also wild. That is not something that would help the housing market. In fact, a 1% rate would be a drastic drop from the 4-point-ish we're at now and would cause an influx of credit into our system, an influx of new debt being made, and the demand would more than likely send home prices and any form of physical asset up in price by squeezing it. Over to the right, we have a few tweets that we can read through real fast if you were curious on if Jerome Powell and Donald Trump have any emotions towards one another. This is 9 of the last tweets that Donald Trump has made about Jerome Powell. First one says, Jay Powell and the Fed failed to stop the problem. The Fed has done a terrible job. That the Fed spent less time on DEI, gender ideology, green energy, and fake climate changes. Inflation would never have been a problem. I can tell you from watching almost every single press conference from the last 3 years from Jerome Powell, I've never seen him talk about any of those things. That's just me, though. One here in the middle, Jerome, too late, Powell, must now lower rates. He's been on this for a while. You can see over there on the right, the perfect time for the Fed chair, Jerome Powell, to cut rates. Too late, Jerome Powell of the Fed. Powell's termination can't come fast enough. He's been on it. And the facts are, lowering the rates does not immediately mean mortgage rates come down, car rates come down, credit card student loan debt rates come down. The federal funds rate is the overnight bank exchange rate. This is the price that banks pay to lend money to one another. It's the price of money for them. So when we see Donald Trump talking about slashing the rates to 1%, what he really wants is, and they are tweets. There's some X's, there's some, I guess X's are tweets, and some truths, but they all get syndicated over to X. The slashing of the rates will not drop bonds right now. In fact, we've already seen it. We've had 3 rate drops in 2024. We had 3 rate drops, and guess what the bond market did? The bond market went up. Mortgage rates went up. In September of October, we've had this year 2 rate cuts. Have mortgage rates gone down significantly? No. In fact, they're higher than when we made the first cut. Fed rate cut does not equal mortgage rates down. And so that's where I get frustrated with the consistent battling back and forth with Jerome Powell. Because ultimately, we're blaming a scapegoat for a larger problem that is inflation. Let's go down to the other two dramas. We'll walk through these real fast. We had the drama of Lisa Cook and the drama of the building. Lisa Cook, one of the Federal Reserve Board of Governors, was recently put under fire by the Trump administration. I think Pulte was the one who originally called her out for mortgage fraud. When she originally was not a Board of Governor, she had bought a property in Michigan, claimed it as her primary property, and then another property in Georgia that she also claimed as her primary residence. There have been documents that have come forward saying this is indeed true, but Lisa Cook was not fired because this happened prior to her position being held. I think there's debate on either side as to whether or not she should be terminated for that. I think at the very least she should be charged for that. That's a legitimate thing, mortgage fraud is. But at the same time, the argument is, does it have to do with her job currently? I'd say no. But at the same time, we all have to be held accountable for the things we do egregiously under the table and under the guise of something that it's not. And if you're under the guise of, oh, this is my primary residence, and you're renting one of them out for a cash flow, I don't like that. The next one down is the Federal Reserve Building. This is Jerome Powell and Donald Trump walking through the Federal Reserve Building. I'll attach the link to this video. It looks like a sitcom when you watch it. It's so funny. It's so funny. Jerome Powell's so just awkward and sitting there, and Trump's doing his thing, and Trump pulls out a letter out of his pocket and tries to gotcha Jerome right there, and you got to go watch it. The building budget had come in over budget for the new Federal Reserve Building. The Federal Reserve claims it has a lot to do with increased parking and asbestos removal, while the Trump administration claims it has to do with marble and fancy fixtures and modernized stuff. And do we really know is the question. And I don't think anything actually gets done with it, nor does it have to do with rates. But it was something that happened over the summer in housing and with Trump and Powell. Last for Trump, we have to talk about Agenda 47. Agenda 47 was posted on Donald Trump's campaign website to talk about the 20 core promises he had for making America great again. This is the 224 GOP platform PDF. And if we scroll up, I want to show you the exact promise we're focusing. There were 20. The exact promise that we're focusing here, you can see it says, to make clear our commitment that we offer to the American people, the 2024 GOP platform to make America great again. It is a forward-looking agenda that begins with the following 20 promises. So if we go into those 20 promises, we'll see the number 3 one says, end inflation and make America affordable again. If we go over to the right, I went ahead and scrolled down. We did this last year and found the housing affordability section. Now, this subsection is the only subsection in this document that mentions housing affordability, mentions anything to do with real estate. And in that subsection, it says that our commitment is Republicans will offer a plan to make the American dream affordable again. We commit to reducing housing, education, and healthcare costs while lowering everyday expenses and increasing opportunities. Again, this was a document that came out over the summer of 2024 pre-campaign. In number 1, the subsection about housing affordability, I want to read those highlighted ones real quick. It says, 5 of them actually, it says to help new home buyers, reduce mortgage rates, open limited portions of federal lands, and promote homeownership, should have highlighted that, through tax incentives and support for first-time home buyers. We haven't really seen a lot of that. And cut unnecessary regulations that raise housing costs. So we took those 5 promises and brought them into that Trump tracker. Can we bring that back up once more? And this link is in the description if you want to look through it. This updates every single week with new data on the possibility of a crash, new bills in the system, cost of housing, regionality, all of that. So if you're interested in this document, check it out. But we have been tracking these 5 promises. In fact, the Agenda 47 document was a reason I even made this. So the Agenda 47 document we've been locked in on. If we go back to it, though, we'll see the 5 promises that we laid out. We can go back into the Canva. On the Canva, we've laid out 4 of those 5 main promises. The first one being mortgage rates. You scroll down to that first blue block. Now, what's happened with mortgage rates? Let's back up into our housing affordability tracker, and let's see exactly what's happened with mortgage rates. Mortgage is right there in the middle. Second column down, we see that we're tracking the mortgage rate, the Fed rate, the 10-year Treasury yield, core inflation, and the median mortgage per month. we can see that all these numbers have indeed improved since the beginning of Donald Trump's term. The mortgage rate has dropped from median about 0.5 points. The Fed rate has dropped from 4.33 to 4.09. The 10-year Treasury yield has begun to drop a little bit, but has gone up ever so slightly in the last months. Core inflation up, but only up slightly at 3.33%. And the median mortgage, $2,670. Now, if we look over at the numbers to the right of those, we'll see that all of those are improvements, down by some way, shape, or form on all of those. So in terms of mortgages, we've slightly gotten pressure down, but it hasn't really opened up any floodgates into the mortgage world. Many people want to see mortgage rates in the 5s and 4s, and realistically, I don't think that's going to happen, but it has been yelled about from the administration for a while, so I think a lot of people want to see it. I don't see it happening anytime soon. Let's go back into our Canva. For our second promise, mortgage rates being slashed, we're seeing a little bit of it. The second was that regulatory costs are going to come down. Now, what's a regulatory cost? A regulatory cost is the cost that a builder has to pay to get a home built. Now, when we're getting a home built, we have permits, okay? We have fees that get paid to the builder after actually purchasing the lot. We have fees that have to get paid to OSHA. We have inspections. We have infrastructural costs that the county has for building the unit as an entirety, including prices to improve the sewer systems and the school systems and the streets. Like, it makes sense because as you build more homes, you got more families, and with more families comes more need for the infrastructure to grow. I get it. But a lot of the costs are really ripping into builders. So the National Association of Home Builders did this study. The study was done with the Census Bureau data on a $394,000 build. $394,000 build. Now check this out. If you were to build a $394,000 home as a builder to get all the sidewalks, to get all the infrastructure, to pay the city, to pay the county, to get the inspections, on that nearly $400,000 home, you're paying $93,000. The builder is $93,870. So basically $94K to build that home. And that's before ordering a shingle. That's before labor. That's before the foundation. That's before sod in the front yard. That's before all of that. So builders are in a tight bind, and that's where they want to slash regulatory fees. And have we seen anything in terms of slashing the regulatory costs for builders yet? No. The administration hasn't done it. The Affordability Committee that was put forth hasn't talked about it. And the committee that was put forth for actually doing this, which was Pulte and Scott Turner, have not done anything, as we know right now, towards the direction of slashing regulatory costs for builders. There's one bill that has been circulated with no momentum. But as of right now, we have not seen any movement on slashing regulatory costs. Let's get to promise number 3. Promise number 3 was first-time homebuyer prep. He specifically said, we are going to prepare first-time homebuyers. If you're a first-time homebuyer, what do you need to feel prepared? Money? Lower rates? Heck, just an affordable home you could work toward, like a $250,000 townhome, something with a patch of dirt that you can bring your dog out to pee. Little stuff. You're not asking for a McMansion. You're working 60 hours a week. You deserve a shelter. You're not mooching off the system or just drinking a 6-pack every single night and calling it a day. You're side hustling. You're growing. You're pushing. Your spouse and you are doing everything you can to push toward more. But you probably can't afford a home right now. And that's the very problem. And so when he said at the beginning of this term and in his pre-campaign promises in Agenda 47, promise number 3, subsection number 4, and then area 1, that he was going to prepare first-time home buyers, I was very excited. Let's remove the Great Shrek, though, to see what has happened. The Great Shrek is hiding what first-time home buyer benefits there have been so far. And there have been none. It's not a glitch. There wasn't supposed to be anything behind there. There have been none. No tax breaks, no mortgage rate assistance, no first-time home buyer programs nationally, locally, any zoning changes, regulations, nothing. Nothing to encourage builders to build smaller homes, nothing to encourage investors to stop buying everything, nothing to get institutional investors like private equity firms out altogether of buying, because even though they only buy a small sliver, that small sliver is way too much. There's been nothing. So we'll continue to watch this, but as of right now, there's nothing federally to say that this exists or anything is being done on the promise of preparing first-time homebuyers. To the 4th promise. Fourth promise was federal land. This is one we are seeing momentum on, opening up federal land for more supply. We also have opportunity zones with Scott Turner. If you follow his completely AI-generated Twitter feed, you'll know that he talks about that a lot. You can look at it. It's literally the same formatting every single time. Scott Turner has talked a lot about federal lands and opportunity zones. Senator Rubin is still very curious around what progress has been made on that, but the last progress we had was from April and an announcement in May. Since then, nothing on federal land. And again, the BLM answer, just not my favorite answer. The Bureau of Land Management is not the answer in my humble housing opinion. Those are the four promises. We have the federal land being worked on, first-time homebuyer prep, no luck, just legendary Shrek watching for updates. The regulatory fees have not been slashed, though we have documentation showing that builders are having to pay exorbitant fees, and it's making home prices higher. And greed. And then mortgage rates, they've come down slightly, but we haven't seen anything federally to make that happen. That's more so been price pressure to reduce rates and a little bit of ease in the bond market, but we're seeing that go back and forth consistently. So as a quick summarization of what we've talked about before getting into our 2026 predictions, we talked about mortgage mania. FHA says undocumented and non-citizens are unallowed to get loans for homes. They could still buy in cash, theoretically, but they cannot get a loan, and nor is there a credit limit or a credit minimum. There's a 50-year mortgage possibly on the way. We'll see if that has any momentum. And we have portable mortgages being talked about. Quick stroke. Could it happen? Logistically, there's a lot getting in the way, but it could be a good solution. And when we have proof that works in other markets, it's just a matter of can our system support it? And like I said earlier, possibly no credit minimums on loans that are government backed. That no credit score limit, I don't like. I don't like giving the banks the opportunity to do that. Trump, we have some talks about affordability, but we've recently seen that he believes affordability is a Democrat hoax. I don't see how the numbers support that. We've also seen the committee set up for affordability and for federal land expansion. We don't have any updates for those committees. Trump and Powell continue to go at it, even though usually when we see Trump talk to Powell, Trump is a bit more on the aggressor, while Powell kind of doesn't play back. He says, all decisions are made based off of the numbers, not politically. You can have your arguments on that, but that's what he says. And that rates will only go down when we have a need for them to go down. And though the job market's starting to show those signs, there is no real reason that we should drop rates significantly if we want to see inflation come down. And then we have his 5 promises broken down in those 4 sections. In mortgage rates, which we're seeing a little bit of downward pressure. Down from there, we have the actual regulatory costs for builders, nothing there. First-time homebuyer prep, nothing there. And federal lands, no updates, and also no proof that it'll work. Let's get to 2026 predictions. Those that want to buy a home in the future, you may be looking at 2026, though. I put out a video, and our next podcast is going to be how to buy a home by 2030. I strongly support the idea of pushing off buying a home. So before I get into these 2026 predictions, there are so many more ways to build wealth than buying a home. Now, I know what you're going to think. Oh, but renting is 100% interest. Oh, but the landlord's just going to up the rent. Oh, but I get it. But can I tell you right now that if you bought a home at today's interest rates on a $400K home, you're paying $26,000 a year in interest? Can I tell you that if you were to buy a home right now with a low to no down payment, that you're going to be sitting in that home for 5 to 6 years before you even have enough equity to think about doing anything else with it? I'm not saying it's a bad idea. What I am saying is maybe there's been a bit of propaganda to make you believe that's the only idea. I love the idea of you moving in with your family. I love the idea of you taking your boomer grandparents, getting them convinced to get a homestead and having 3 generations move on it. I love the idea of finding a vacant piece of land and building a really dope treehouse with you and your buddies and living there. I'm not supporting that legally. My attorney will hate that I'm supporting that because I'm not at all. But I love the idea of creative living. The idea of getting a standard 30-year mortgage and that is your key to wealth. I don't believe that is the number one key to wealth anymore. I don't. If you were to have gotten a 2% loan on a $250,000 home that's now worth $400K, yeah, you got a lot of equity. Incredible. But I don't see that gigantic jump happening again in that way. It probably still goes up in pricing, but not at this 20, 30, 40, 50% mark that people are hoping for if they buy today. Okay? So I just want to start with that before we get into our 2026 predictions that next week's video will be for you. How to buy a home by 2030. Here are our 2026 predictions. Let's remove our first legendary Shrek for our first prediction. Max 2% price compression. Listen, nationwide, I do not see that we're going to see a lot of price compression. We're not going to see price reductions at a nationwide scale. I do think we are going to see price compression in 3 places. Number 1, Florida. Southwest Florida specifically, oh my God, way too many homes. You got hurricane-ravaged properties. You got investment properties people don't want anymore. And then you just got this whole tax scenario, insurance scenario that is driving people out. I have never in my life in the last 10 months, 10 months, that's year to date, gotten more calls from people looking to move to Delaware from Florida than ever before. Way more people that want to move to Delaware from Florida. They also have 11% of the entire nation's inventory. So when we talk about high supply, Florida leads it. Number 2, California. California costs are just obnoxious. It's somewhere around 84% of California residents can't afford the median home in California. We're seeing price compression in California that'll more than likely supersede that 2-3% mark. And the last one is going to be, that's not how you spell outlier, outlier markets. So think of these like vacation-ish markets. Think of these like secondary home markets. Think of these like Denver. They're seeing price compression. Think of this like Honolulu. I don't know how to spell Honolulu. Is that how I spell Honolulu? Honolulu? Easy. Nailed it. Denver, Honolulu, Las Vegas, and Nashville. These are all 4 areas where we are seeing price compression. California, Florida, we are seeing price compressions, but these are kind of outlier markets. They're not the typical American neighborhood, American town or township. So they're seeing different reactions. We're seeing a lot of people that aren't moving just due to recreation anymore. Thinking, oh, you know what'd be nice? Let's just move. That sounds fun. People aren't doing that nearly as often. It is a much bigger financial decision right now to sell and buy a property in America. And that's where we're seeing some secondary markets seeing a drastic difference from the rest of the markets, especially the Middle West, not the Middle East. I'm not sure how their prices are looking in Saudi Arabia. But if you look at the Midwest of America, the Northeast, the Mid-Atlantic, you're seeing price points expand in these areas where you are seeing some price compression along the West Coast, areas of Texas, especially Austin, and these outlier markets. Shrek number 2. Again, that's pricing prediction of 2% compression nationwide, maybe 3% nationwide. We'll get the pockets of compression, but nationwide, not much. A lot of economists say it's going to go up. Oh, Shrek's shaking. He's about to evolve. What's he going to be? Mortgage rates don't hit 4%. Now, right now, we have 2 things that are driving mortgage rates. I want to be very clear. Jobs and inflation. This is what's driving rates. If you ever hear someone say, the Fed rate equals mortgage rates, I want you to grab them by their cheeks and look deep into their eyes and say, it's okay not to know everything. We can learn together. Because this isn't true. Now, correlation versus causation, these 2 in the past have moved in tandem very closely. But the 10-year Treasury bond and even the 30-year Treasury bond are much better representations of how much these long-term loans like mortgages are going to be. So when we see inflation, how does that affect the bond market? And when we see jobs going down, job losses going up, what does that do to the bond market? I'll tell you exactly what's happening. As the job market is getting worse, we are getting more and more signals at the potential of rate cuts. When we have the higher potential at rate cuts, what happens to inflation? Well, when the rates get cut, credit gets expanded, goes up. And when credit gets expanded, demand on debt-based items goes up. So a debt-based item would be a mortgage or a car. If you get higher demand on debt-based products because the credit is higher, there's more credit out there, there's more debt to be obtained, prices typically go up, meaning inflation is going up. Now, why is inflation going up affecting the bond market? Because the bonds are getting what's called a yield. Let's say it's a 4.5% yield. What's a yield? A yield is a return on investment. It's ROI. And when we have inflation at, let's say, where do I write it? Let's say we have inflation at 3%. That means my yield has to be at least a percentage or so higher than inflation. And if I have a 10-year bond, guess what? I have to be positive that for the 10 years I'm going to be holding this debt, that inflation's not going to rip. Does that make sense? Because if inflation rips higher, it's ripping into my return. My dollar's getting weaker. My investment is less. And so when the 10-year bond rates are going up, what is that signaling? It signals that the bond investors think inflation could possibly go up. And when inflation's going up, so is the price of everything. I hope that all makes sense. Put a 1 in the chat if that all makes sense. So when we're talking about inflation, when we're talking about mortgages, when we're talking about the Fed rate, know this to be true. If inflation's going up, so too are mortgage rates. Just know that to be true. If inflation's going up, so too are mortgage rates, and rates on cars, rates on financing a burrito, rates on financing anything, a fence for your yard, clothing. People are financing. Hear this. 1 out of 4. Sean, you can come on the mic real quick if you know the answer. What's the name of the pay later service that you can use? Is it Carvana? Not Carvana. Klarna. Klarna, I think it might have not even been them. Pay now or pay later services. It's saying it's Klarna. There you go. With a K. 1 out of 4 of the uses of their lending service, which is hey, you can't pay this right now. You want to pay back 4 to 8 times later. 1 out of 4 of the uses of their app are for groceries. People are financing groceries. So here's this crazy conundrum. We're dropping the Fed rate slowly but surely, meaning banks can lend money to each other at a lower rate. But every time we lower the rate, we're causing signals of inflation that are raising the bond market, which is raising interest rates for retail market items like housing, cars, and burritos. So the person who's getting their groceries financed is having a higher rate to pay than the banks who are exchanging funds simply because the bond market's not responding. The banks are benefiting, except for the fact you're not taking on new debt, but you are having to pay higher rates because the bond market is demanding a higher return because they see inflation coming. That's what's happening. And as Christmas is approaching, I could see more people utilizing credit card payments, Affirm-like payments, Klarna-type payments to pay for toys, to pay for Christmas dinner. We have people that are struggling. And these pay later services are only going to dig people in a deeper hole. It's only going to dig people into a deeper hole. So again, I only see prices dropping a slight percent, and I don't see rates going to that 4% rate. I could see government loans getting maybe into the low 5s. You can knock out a high 5 now if you're lucky. I don't see it getting naturally below into the 4% range, and if it does, it's definitely not hitting 4. Like we're teetering on 4.9, 4.8, and that would be good. That would help. But again, if you're hoping for 3%, 4%, 2%, you're not crazy. It's not going to happen. It's not going to happen. So let's get back into our Shreks as we finish this out, our year in review. We have our 2026 predictions. First prediction, we don't see a lot of price compression. Number 2, we don't see mortgage rates drop significantly. We're not going to hit that 4.0 mark, not even close in my opinion. What's the third, Shrek? Is it going to be good? I hope it's good because the last 2 were mean. I didn't like them. Oh, Jesus Christ. Investors buy 30% of homes through the first half. So through the first half of 2026, we will see investors buy nearly a third of all housing. If you missed it, there has been a report that through Q3 and Q2 of 2025, that 33% of all homes purchased were purchased by an investor. And no, not BlackRock, okay? Not BlackRock. Blackstone is the one buying all the investment properties. And there are reports that say, hedge funds are going to own 40% of homes by 2030. Not true. Not true. 2021, there was one article that came out around BlackRock buying homes, and people have run with it ever since. BlackRock's not buying homes. They're buying majority shares in home insurance companies, majority shares in home builders, majority shares in title companies, majority shares in the supply mechanisms that get the supply to the construction sites. They're buying stakes in the automotive industry, in the agricultural industry. They're buying up data centers. They're buying up canal ports. They're buying up everything institutionally needed, infrastructurally required for our country to operate. They don't give a care about beating you to the closing table for one house. They want to buy up the entire power grid so they can up your electric bill. They want to buy up all of the home service companies so they can up your service costs. They want to buy up all the HVAC companies so you have to go into debt to fix your air conditioning. They're not buying up all the properties. And you can Google it right now. How many properties does BlackRock own? Next to none. It's Blackstone that owns more than 30,000 through the ownership of Home Partners of America. I think it's called Silverleaf, and another one called Tricon Residential. They're building build-to-rent neighborhoods. They're buying properties and they're holding them and they're managing them. But even that 300,000, there's 146 million single-family homes in America. So it's still a small percentage. Should they be able to buy anything? No. Institutional investors should be indefinitely kicked out of buying in our market. Investors should not be able to place an offer on any home for the first 45 days of it being on the market. And if somebody were to sell their home to somebody who's a first-time home buyer instead of a second-time buyer and investor, they should be completely nullified of their capital gains tax. That way, sellers might actually sell and not sit and wait. All that to be said, we are seeing a world where investors are buying more and more. And at this exact moment, investors are buying 33%. I don't think that number comes down much. I do think we'll have a little bit more demand from the normal everyday person. But to be honest with you, the normal everyday investor buys 19.6% of all properties at this moment. 19.6% of all properties at this moment. The person who's getting a property and they only have anywhere between 1 to 9. Your typical Dave Ramsey client. The person walking out of the gas station. The person you work with that has 3 Airbnbs that wants their 4th. The mom and pop that wants to add to their rental portfolio. These are the people buying the properties. And they're buying them at a larger scale than first-time buyers and normal buyers. Why? Because when they go to the bank and they need to get a mortgage, they have what's called collateral. When they walk into a bank and you walk into a bank, those are the two major differences. They have it and you don't. When they walk into the bank, they have an investment portfolio of 6 homes that have equity, that are cash flowing. The rent's higher than the mortgage. They have an IRA, retirement account, 401k, TSP, that has $180,000 in it and a checking account with $60,000 in it. So when they want to get a $250K loan and they have nearly $250K in liquid assets in an entire investment portfolio, do you think you're going to get a lower rate or they're going to get a lower rate? They're going to get the loan or you're going to get the loan. They have collateral and the banks are more willing to lend to them. Their investors are more willing to bend for them. And that's just the fact of the matter. So I see investors buying more. I don't see the bond market shifting any bit. Even though Trump has said the 1% rate thing, if he gets this person, his Fed Reserve chair in May of 2026, and he drops the rates to 1%, 2%, maybe we do see the rates drop in the bond market. But I see the bond investors saying, whoa, we're going to go through another COVID inflation phase. I don't want my bonds losing funds. I'm going to demand a higher yield, a higher return on investment. And that leads to you having a higher mortgage rate. So here's our year in review. We've been promised lower mortgage rates. We've seen a little bit of pressure. We've been promised better home buyer affordability, especially for first-time home buyers through funds, through tax incentives and programs, and we haven't seen any. We were promised regulatory costs will get slashed for builders so builders can build more affordably. We haven't been shown that. And overarchingly, from affordability to the grocery store to in the home to buying the home, nothing has been shown to be, in the stats, more affordable. So as of right now, as we sit at the end of 2025, prices are down slightly. Supply is up about 200,000 units, and we are on a pace that could lead to pricing pressure. I don't see the price pressure being significant enough to bring prices down 20, 30, 40% like most people want. I do not see a home crash in 2026 happening, though I do, and I've said many times that more than likely we will have a bank failure and or quantitative easing rip into our market in 2026, first half of 2026. But I believe this will only hurt the working class even more and leave the investors more opportunity to buy at discount to improve their portfolios. This isn't great, but it's what I think will happen. And I don't mean to fearmonger, as I hope everything that I've said is the opposite. I hope all of the promises get made true on. I hope that investors can go F themselves and they get, just different investment portfolios. They start investing in bonds and stuff like that, boring stuff, and not shelter, not commoditizing dirt. But to be honest with you, I think it continues because we've seen no executive orders, no legislation that has led me to think that any changes will be made. So with that being said, that is our year in review. Next week, we will be going through how to buy a home by 2030, more positive logistical steps you can make to have true wealth within 5 years, including owning your own property. This market has been wild. The promises largely have not been met yet, and we're going to continue to track it. As I said, the Trump tracker is in our bio, as well as the Canva graphic if you'd like to click through and read some of our sources. We always put our sources out in the open. We don't want you to be guessing on where we're getting our data. I hope you're great. Stay great. Fight for you. Fight for yourself. Make it great. Love you. Talk to you later. All right. If you get imposter syndrome, how do you get over that? That is a confidence thing. It's the last thing I'm going to answer, and then we're going to get started. a imposter syndrome is a confidence thing, and it is a self-view thing, self-love thing. If you feel imposter syndrome around doing something, it's because your brain does not have the operation capability of knowing what a positive outcome looks like. If it's something you've done for the first time, never done it before, you do not know what a positive income feels like, and so your brain can't picture it. So you're only picturing negative outcomes. And that comes down to confidence, and confidence comes down to making sure you do what you say. What you think and what you say is word. If you say you're going to get up at a certain time, get up at the certain time. If you say you're going to eat a certain way, eat the certain way. If you say you're going to work out, read the book. Whatever you say, do. And when you stack up those, I do it every time I say it, I do it every time I say it, I'm the person who does what they say, all of a sudden, the repetition leads to less imposter syndrome. It's a very real thing. Not trying to say it's not real or you're going to push through it. You absolutely can push through it. It just has to do with repetition and believing you're the type of person that succeeds at those things, even if you don't have proof because you've never done it before. And I get imposter syndrome all the time, but there's a difference between fear and courage. You can be afraid of something, but you can still do it anyway. And that is courage. Courageous people still are fearful, but they do it anyway. All right.
That's a really good motivational clip right there.
We'll do it. We'll clip it, as the kids say.
Clip about.